Okay, so now it's a time for our panel discussion. From investment to impact, key advice for food tech founders. And now please welcome to the stage our panelists and of course the moderator. Alberto Sparrow, Managing Director, Head of AgriFoodTech, Santander Corporate and Investment Banking. Myriam Rouis, Investment Service EIC Fund, European Investment Bank. And of course the moderator, Dr. Wyse, Venture Capitalist Founder and Managing Partner, Spruce Capital Partners. And I'm missing someone here in the scenario. I will appreciate if you introduce yourself. I'm missing this in the scenario.
Yeah. So Josko Bobanovic, Sofinnova Partners.
Thank you very much, and the stage is yours.
Well, First of all, thank you all very much for staying for the best panel of the session and frankly, the most relevant panel in the session. So there was a panel this morning on cultivating capital, which I think really set the stage for what we're going to talk about. And that is that we, like every other industry, goes through cycles. And we are now going through a down cycle. And I think all of you here would say that raising capital over the last year has been more difficult than it was 2 years ago. And what we're going to talk about is that cycle, why it came about, and what the panel here is going to share with you all their expertise in having managed through not only their operations, their funds, but also their portfolio companies that they have invested in and advise, and what they should do to make sure that they come through the other side of this down cycle, and the whole industry will end up being much stronger for having gone through it, because we will have cleaned out some of the things that got us into trouble. So what we had is we have agriculture, the agri-food sector has got huge challenges to address the feeding a global population that's growing rapidly, to do it sustainably, to reduce environmental impact, to improve the nutrient density of these food products, and keep food still at a low and affordable price. The challenge to do that, we thought we could address with some of the converging technologies that came about over the last 4 or 5 years. And those converging technologies, along with the challenges and the opportunities that investors and entrepreneurs saw in ag food space, coincided with the low cost of capital. And as a result, we saw a lot of companies get started. We saw, frankly, a lot of naive investors come into the space that didn't really understand the complexity of the agri-food system. And the combination of the usual, what passionate entrepreneurs do, and actually what investors do, we look for opportunities and we overinvest and we overpromise and underdeliver. And that's what has happened. So now in 2023, as we saw inflation come on, came out of COVID, we saw a lot of capital coming into the economy. It drove up those prices. Now with inflation, we're beginning to see that capital tighten up. Interest rates are going up, capital is getting scarce. And investors didn't see any exits. The companies that we invested in are not doing well in the marketplace. And as a result, investors got conservative, capital tightened up. So we're now going through a readjustment. And so what this panel is going to talk about is, what do entrepreneurs do, CEOs of companies, what should you do to manage through this difficult period so you come out on the other side stronger, and the industry comes out stronger, because we've now right-sized, we've gotten reality back into our decision-making, and we'll come out of this as a much stronger industry, positioned to address what's going to be a long-term trend of accommodating the challenges and opportunities for the agri-food system. So the panel that we have today are a number of seasoned investors in the space. And I'm going to give them a chance to introduce themselves, and then they're going to talk about 3 or 4 things that they would advise companies to think about as we go through this period. And then what I want to do is not have us talk, but we want to talk to you in the audience and get your perspectives, answer your questions, because this is really a critical time to get right. So let me start off, Stanley, with you and talk about your experiences and what your company is doing.
Thank you, Roger, for the introduction. I'm Alberto Sparrow. I'm responsible for the agri and food tech sector at Santander. Santander is one of the largest commercial banks in the world with approximately 1.8 trillion euros in assets, over 160 million clients worldwide, and it's also one of the largest banks in the Eurozone by market cap. In our investment banking division, we have presence in over 20 countries, mainly in Europe, America, and the US. No? So going to the point that you mentioned, Roger, should I give a brief comment on that? It's very true what you said. We have seen a huge decline in investments in the sector. From the peak that we reached in 2021 to 2023, investments decreased around 80% in the food tech sector only. No? And that is a very steep decline, which has made fundraising very challenging for companies, which probably many of you are experiencing now. No? So my main advice is to be prepared in advance, know very well when your next funding round will be, so in order to be prepared with enough time. No? Processes are taking longer, investors are more wary when they decide when to invest, and negotiations also are getting delayed. Also, being prepared in time is critical. And some just key points to mention that maybe we can have in the Q&A session, things that investors look at, and maybe Josko can comment on that, is having a solid business plan to show investors what risks are the company facing and how you're mitigating them, very detailed economics of the business plan, and also who is on your cap table. No? A cap table is a very important to support you not only in the growth stages, but also for future rounds. Having a good combination of founders, industrial investors, and financial investors can make fundraisings more successful.
And I guess just following up on that point, as you make that presentation, be honest and transparent about the market situation you're going into. It's not what it was 2 years ago. And so be really clear with investors that you understand that.
Yeah, for sure.
So Myriam?
Yes, hello everyone. So I'm Myriam, I work for the European Investment Bank. We are deploying the equity component of the EIC program from the European Union. So the EIC fund is the fund that we're deploying. It's a 3.7 billion euro program budget that we have started investing in 2021. We have already invested 800 million and committed 2 billion, so it's going pretty fast. A large share, a significant share of this is agri-food. So it's still a sizable portfolio, even though it's not our largest one, but considering the total portfolio that we have, it's still pretty sizable. So the program, the objective of the program was launched by the European Commission to fill the market gap that we have noticed versus, for example, markets like the US, where companies in deep tech were underfinanced by the private market. So we finance companies as from TRL 5 up to TRL 9 for the equity part. And we only invest in deep tech, breakthrough technologies in all kind of verticals. I will highlight later when Roger wants to discuss this further, how the public financing can de-risk companies in that field. Notably, for example, we see in the food agri-tech a lot of companies that are quite capex intensive, and that's a big hurdle when it comes to finding investors in the current market conditions. Our products are exactly the type of products, and I've heard this being told so far at this Congress, actually, that public financing is a very good tool for these aspects of things.
Josko, you've been through this more than once. Talk to us about how you've advised and how you're advising your companies today.
Sure, appreciate. So It's true, capital has been scarce. Startups need to figure out what are the right expenses to make, but oftentimes they focus so much on money coming from investors. And there are other sources of money, such as sales. Okay. So we encourage startups to think about, in these difficult times, who can buy your product, service, idea, where else can the money come from? Because everybody in this room and beyond sits on something unique. So you need to find a way to accelerate your path to revenue, because not only is that going to bring you cash, which is worth a lot in these days, but it's also going to catalyze your ability to fundraise. Because what are the investors asking you? They're asking you, where are the customers? Where is your revenue? And when are you going to get to revenue? So by trying to find somebody who wants to pay for your partnership, service, product, whichever way you can package it, you're addressing a number of issues in this market. So think about that first when you can.
So following up though, Josko, what would you advise a company to do that if they see that they've done a financing and they're now going through that spend and they're trying to hit milestones, and they see they're out raising money and they notice that it's tough to raise money? When should they make that decision to reduce the burn rate? The burn rate is the killer, right? So when should they begin thinking about that? And what degree should they execute it? You know, the adage is you cut once. And what's your thoughts about that?
So I guess cutting cost is easier said and much more difficult to execute. Okay. The key question to ask in that situation is, what are the priorities of the company? What is it that the company must achieve, and what are the nice to haves? Because every single company, every single person has absolute priorities, which is survival, and then nice to haves. And so in assessing what the company is doing, it's important not to just try to absolutely cut cost, but to eliminate, let's say R&D that's not short-term accretive to success. Eliminate things that are not going to be delivering value in short term, but at the same time, what companies make mistakes about, they say, oh, we are all about R&D, okay? And they say, well, let's cut commercial, okay? Well, going back to my earlier point, if you cut commercial, you're never going to see money, okay? So you have to be smart about making those reductions, but at the same time, not undermining your future completely. Because, at the end of the day, it's not about survival, it's about winning, right? And our business, when I say our, that means startup business, it's about coming out on top. It's not about playing to draw.
And you mentioned other sources of capital. There's usually, I'm going to come back to you, Myriam, some of those other sources of non-dilutive capital could be grants, it could be loans, or the kinds of funding that you do as well. And excuse me, and particularly during these times when you have conservative investors, reducing risk is also an important part of that survival strategy. So Myriam, talk a little bit about the kinds of things you're investing in to de-risk the market opportunity.
So the main tool we have to de-risk is that we provide half of the money. So that's just the volume effect. That's big, considering that we're an almost 4 billion euro fund. Then for the rest, there's the grant component of the program, which is pure de-risking, non-dilutive, of course, financing R&D. So this is ideal, of course, up to 2.5 million that is provided for per company for that. But there are other ways for the companies to de-risk. If you look at this CapEx issue, well, you can take it at the core of your business model and look at your technology and think, okay, how can I define my technologies in a way that I'm not going to bump into this CapEx issue? For example, if you take solid state fermentation, one of the big topics, fermentation of this Congress, it's way less CapEx intensive than liquid state fermentation. Okay, I'm not pitching in favor of SSF. There are other good points of liquid state fermentation, but I'm just saying these are things in the current market conditions that have an advantage. Also, looking at the core of your business model, we've seen companies, you were mentioning cutting costs. We've seen companies that tell us they're going to go bankrupt next month if we don't unlock the money. 6 months later, they're still there. So how did they make it? Well, there are other sources of financing. There are other undilutive sources. There are ways of cutting costs and reprioritizing in tough times. And we've seen companies that were looking at building a plant. They didn't get the money. They still built something. And actually, under the pressure that they were under when they did it, they actually came up with a best technological approach. They improved their technology under pressure to cut CapEx further and to potentially even cut OpEx. So all these situations force you to improve. There's also and this is at the core of this circularity, reusing resources that are underused, including equipment, using, for example, the fermenters of your providers of side stream when they are breweries, underused equipment of any kind, especially when it's in your value chain, when these are your providers of side streams. And then you can also break down the risk. What investors don't like is having to put a very big amount at the beginning without seeing any milestone until the end. They like to see milestones. So you can also break this down from a CapEx perspective. Of course, if doing a smaller plan first is the same, and at the end later on doing your full commercial size plans costs you double the money, it's not worth it, right? So you have to think it through and see how you do it, but you can have intermediary milestones that come also with sales milestone, right? Because when you have a first production capacity, you can unlock some sales, and this is what your investors want to see.
So what do you look at when you're doing a partnering investment? You're doing a co-investment, right? So what are some of the top two things you look at as you're evaluating a potential? And as she's answering that, I'd like to have the audience be thinking about some questions you'd like to pose to the panel.
Yeah, that's a typical questions we have. So first, simply, we're public money, so we cannot deploy alone. We have to have a private investor co-investing with us, and we call it our qualified lead investor as per our definition, which means qualified in the sense that we need somebody who has a reputation and knowledge of the investment exercise and can deploy the money at market terms. And the second point is that investor can help the company with its challenges. It's not enough to bring money. All our companies, they also need some support of some kind with some sectoral expertise or network, if it's potentially also a strategic investor or even, of course, a financial investor that has his own network to bring to the table. Whatever it is that is a challenge to the company and that the investor can help with, that is relevant.
So Alberto, you help a lot of companies raise money, and how would you modify their pitch today versus what they did a year or two ago?
Well, I think and I've seen some great pitches in these sessions, and most companies are aware that it's very challenging to raise funds, So they have to be realistic of what they can achieve, and I think that the most important thing is promise what you can deliver. If you really can achieve some certain milestones, be open with investors that you're going to get there. But over-promising can all sometimes lead to a frustration on both sides.
The pendulum swings back pretty hard.
Yeah.
So is there any questions from the audience for the panel? If not, maybe just, I think we only got a few minutes left. A couple of things is, as your company, as an investor, we always are watching the burn rate and making sure you got enough runway. And then the other thing is we're very leery of companies that raise too much money, and I think that's been a problem over the last couple of years. There was I'll just give you a recent example. There was an announcement of a company using AI to do drug discovery, and their Series A was $1 billion. And everyone was going, my God, they really need to focus and make sure it works before you deploy that much money. So there's a lot of money out there moving now towards AI. But I would also I guess from my perspective, is that CEOs need to be very wary or very aware of what their surroundings are and be ready to pivot and make tough choices very quickly, because time is not your friend. And for a small company, it's all about the cash and time you have to execute against your priorities. So being flexible and ready to pivot is a really important attribute to make sure you think about. You want to be passionate and moving forward with conviction, but at the same time, you need to be very careful about preserving the company. So, Josko, do you have any closing remarks? We only have a couple minutes left. Anything you'd like to add to the discussion?
Yeah, I'd like to add, especially for corporates that are in the room, okay, a word of encouragement, because you can play a pivotal role in these moments, because a lot of these companies need confirmation about what they're doing. And that confirmation may come through simple action of large companies ordering something from a small company that's part of their innovation product, okay? And what I mean by that is that the bankability of an order, it's enormous in the investor's eyes. From a corporate perspective, there's zero cost. You're asking somebody to produce a novel product at a particular price with a particular spec. If they do it, you'll buy it anyway. If they don't, you haven't lost anything. The value of that order for the startup is enormous. So think creatively how you can help these startups by moving the needle for them without damaging your reputation at all.
That's a very good point. Validation, it's de-risking essentially for investors as they look at it. Myriam, do you have any last comments you'd like to share?
Yeah, I would say it's important to continue thinking ahead, thinking forward, because we see a lot of technologies. What a lot of you guys are doing is very disruptive, is patented, is new, but things move very fast, and you have to always stay ahead. And we've seen companies that recently, develop products thinking they're using a side stream that is a waste that nobody's using. A few years later, they're not yet even on the market, and the product is no longer is in high demand. So, and that relates to what we said earlier. Take the low-hanging fruits, because you need to have a POC, you need to show traction, you need to give something to fit to your investors very soon to create also the financing traction. But also think about, you have disruptive technologies, you have something that is innovative, that is not obvious, that not everybody can do. Use it to address the most difficult challenges, something that your competitors are not working on, some side streams that nobody has managed to recycle and that are in great volume. And even if some other people start looking at these, you will not compete on the tough market in a few years.
Alberto, any last comments?
Yeah, just I think from what we have seen, we have reasons to be optimistic. The market is picking up. Investors know the errors of the past, and companies have learned from that too. And we think that food tech is really here to stay. It's really changing the way we perceive food, the way it's produced food, and there's a huge demand out there that needs to be satisfied in a more sustainable way. So I think these technologies that are emerging are a solution to one of our largest problems.
And we all know that food and agriculture is going to be there for a long time. So thank you all. Thank the panel for their presentation, and all of you, let's work our way through this. We're going to come out stronger, and there's a huge market opportunity out there and lots of good technology to capture value. So thank you for your attendance.
Thank you very much. Thank you to our panelists and our moderator, of course, for a great discussion and being with us and sharing your insight. Thank you.